This earnings season, while most traders were gambling on options and losing money, our members captured huge moves. There was a 100% move in apps, which just happened in one day. It wasn't luck or guesswork. It was because we have recognized a powerful pattern that appears when companies deliver massive earnings surprises. Today, I'm revealing exactly how to spot these moves before they happen and how you can apply this same strategy every earnings season. We will use real life examples that happened this previous week to show you how to profit. Now, earnings look random on the outside, but after digging a little deeper, I found that they follow a specific pattern that combines earnings surprises with a technical setup. So this is a very short summary of what you need in a very strong earnings play. It's best when the market is bullish because 75% of the stocks follow the market. You want a stock in a bullish industry. You want a gap up that's at least 10%. You want a gap up coming from a very huge base. And you want a great earnings report or a super growth stock. We'll go through the buying and selling and the details that I'm about to show you. And our first example is going to be Root. Now here is a recommendation that I sent out to the subscribers of the newsletter, so you should sign up for that if you're interested in such a service. We should look at the weekly chart so that you can see where it's coming from. So we see this very huge base, and this base had about 30 weeks of consolidation. And then while the stock leaves that base, we can see that it gaps up on earnings. This is something called an earnings play. The stock gaps up because of earnings. And what are we seeing this day? We said we like to see a stock coming out of a big base. We do have a big base. That's the first thing. You want it to be on a bullish day in the market, in a bullish industry. For this particular stock, I checked that it was in the financial industry, which was bullish, and the stock market was bullish that day. And we like to see either a good earnings report. This is 5 earnings reports away. So it was, I think, 1, 2, 3, 4, 5. This is the earnings report. There was 173% growth in revenue and earnings per share growth of 65%, which is really great. But also, we had at least 40% surprise in each of these. So there was a good earnings surprise. It was a growing stock, despite the fact that it was not making profits. People are looking at what it's going to be doing in the future. It's coming out of a very huge base. Whenever you see huge bases like this, the stock has been consolidating for a while. It's not going down, meaning people are not willing to sell it. So once it has some really good news like this, it just starts to move. So we can go into the daily chart to look at really what happened. I found for the really good earning moves, they just start and they go that day. They don't try to dither around. The best moves always just go. And just knowing that helps you to get out of those moves if they're not working well. So the risk is normally 1.5 risks of the previous day before the earnings gap up, which was 0.9. We see it up here. I do have the 1 ATR, and then this is the 1.5 ATR. Okay, so that was about 0.9. So we have 0.9, which would have been the risk. So what you can do is that you can buy half at market open, half at 10-minute closes. So here you would have risked about 8% of your money, and the maximum profit you made was about 600%. Of course, for such a big move from such a big base, what you like to do is that you just want to wait it to cross under the 20-day simple moving average. So for me, once it goes 3% under that, I would have exited because it's coming from a very big base. If it's coming from a small base, I'm going to show you what to do. So here you would have gotten, let's say you risked $100, you'd have gotten 52 times $100. That's how profitable this move is. Of course, you get 52, but the maximum you'd have gotten was about 80. So by the time you sell, you're kind of like, the drawback is huge. It was about 30% move from the top. Okay, so it happens again. We see something here, a very big base. I thought it was going to break out. I tried to get it on this day, but it didn't move immediately, so I knew it wasn't ready. You can just get out on that day. Then it happens again, and that's when I sent out the trade for the people in the newsletter, so you can see exactly what I did. Risk is 1.5 average true ranges. As soon as I buy, I put the risk below the low of the day because I know that, hey, I don't want it to come below the low of that earnings day. So I'm no longer risking, let me say, because I will risk 0.6% of my account, 0.7% of my account. So now I'm not risking 0.7. Now my risk is more like 0.3% of my account because this is like half of that. And then I just wait for it to close under the 10-day or the 20-day exponential moving average. So since this is coming from a very big base, I'm going to wait for it to close under the 20-day. But when you wait for it to close under the 20-day, that means you're giving back some profit. Or you can use the 10-day. So whichever works better for you. 10-day is normally very good from small bases. Big bases, 20-day might be better. Okay, next example is apps. So this one did 100% move in one day, and then we just go back. Let's go to the weekly chart. So you see the earnings are not good. So remember, we need either a it's either a super growth stock. Clearly, this is a stock making losses, so it's not a good one, for example. But when the earnings come out, what do we see? We see an earnings surprise of 1,000%. So whenever you see earnings surprises over 50% for both, or each, if one of them is above 100%, it's a very good sign. And then you see a 10% gap up. The market is bullish that day, bullish industry. That is a great buy. So you see here 1,000%. If you see 1,000% anywhere in the earnings or the revenue or a surprise, that is a very good candidate. So we see this one. You come in that day. This one did not. You come in that day, you risk 1.5 average true ranges. So it was 0.31. So you're risking 9%. So if you have $1,000, you're risking about $96. But what happens once it moves up on that day, you move your stop immediately. So now if you have $1,000, you're not risking 96, you're only risking $28. And then how much could you have made? The maximum profit you would have made was about 113%. So from your $1,000, you make $1,100 while risking $30. That's the maximum. Of course, I don't think anyone could have sold there. But since you're using, since this one is not a very super earning stock and it's not showing great earnings, I would just sell using the 10-day, or I would sell using just once I reach 5 risks, I know that I should get out. So 5 risks is pretty good. So I could have sold here on the same day about 4.8. So you make 5 times your money back. Because remember what I talked about. After a gap up, expect 5 risks to 10 risks from a good big base. If it's a small base, 3 risks. So this was a very big base. So the reason why this is not a very good base on the weekly chart is that it goes very deep. For the great earnings like Root, remember the base didn't go down so much. You can see it didn't correct so much. So that was a very, very good base. Whenever it corrects too much, that means the stock is weak. You need something which is a little bit flat. So that was apps. We saw that 100% move. This is an earnings play, so it comes back and the move has fizzled out. But you could have made in about just a week, and you make 100% on your money back. Now, the next example is PRCH. This one happened this week. Now, this one was a little bit very, very tricky. So we see the earnings growth was great. Because remember, before the earnings came out, we didn't have this 1,000%. So it kind of stopped here. So the earnings, they're okay. They're not that great. You look at the return on equity, it's okay. It's not that great. But then we have a base. For the big bases, we want at least 10 weeks. So on the weekly chart, you just count 10 weeks. Okay, so we see 11 bars. So that's 11 weeks of consolidation. That's a first good sign. On the day, we have a gap up, 26%. That's a good gap up. It's not yet out of the base. The reason I did not buy this one in particular was because the market was bearish that day. And when the market is bearish, a lot of the stocks are going to fail. But you can see, despite the fact that it was a very weak market, this one withheld the storm because the earnings were just so good. So it's coming from a 10-week base, gaps up on earnings. You just enter here about 4.87 at open, risk 1.5 average true ranges of the day before, 0.6. Okay, so we have 0.6. Now you already have 4 times your money. So maybe you've already sold a half. So what I like to do is that once it goes, one risk in my favor, depending on the size of the base, if it's a very big base, I'll sell a fifth of the position. If it's a very small base, I'll just sell a quarter of the position. The reason this helps to sell the position a little bit early and take some money off is because if it's to come back and return, you're not going to lose as much. That's the first thing. And then it just helps you control your emotions and take some profit just off very quickly. So yeah, as soon as it moves, on that day, you've already raised your stop. You're no longer risking 12%. You're basically even risking nothing because now your risk is going to be like just below the low, just 1%. So let's say you risk $1,000, you're risking $120. Now you're risking about just $10 to make $500. So I think that's a very, very good risk to reward ratio. And this one, since it's coming from a very big base, what I would have done if I had this stock already, just wait for it to close under the 20-day simple moving average or the 10-day. Very big bases, I use 20-day because you see here, we have this huge gap up. The blue line is the 20-day simple moving average. And then you can just ride this. Once it goes 3% below, you can sell. Or if it closes below. So here, yeah. So there I could have exited around here. Oops. You could exit around here. So you make a 182% gain. The risk could have been about 17%. So that's how these things happen. Next one was Nvidia. Very easy move. I like this one. Now Nvidia is not looking good. So here I was showing an example of how it's going to crash. But let's go back to its earnings play. Okay, so here we have Nvidia. Let's look at what happened for their earnings as well. So the earnings day is here. If we go on the weekly chart, we can see which week it was. So we count the number of consolidations. So the consolidation, I kind of start from where there was the highest high. So I'll take this as the first bar to here. So it's 10 bars. So it's pretty good consolidation. So here you can use a 10-day or 20-day simple moving average, depending. For me, if it like this one took 2 weeks above the 10 days, so I would probably just sell using the 10-day, because here you can see it's trying to follow the 10-day. So you can kind of like just use your brain to kind of see whether you should do the 20-day or 10-day. But 10-day is safest if you don't know what to do. So we have a 10-week consolidation, gaps up on earnings. The gap up that day was about 7%, and this is a $2 trillion stock, so this was a very big gap up in money. That means big dogs are buying, and we know how to risk. So our risk is 1.5 average trend of the day before, $4.73. Okay, so we put that there. Oops, okay, let's just use that. And the maximum risk to return ratio we could have gotten was 8. Remember, 5 to 10 risks from a good big base. Market is bullish. Semiconductors were bullish. The surprise was not that huge, of course, because Nvidia is highly followed, and also I don't think it could grow any crazier than this. But remember, it was a super growth stock. Look at this earnings table. So even if the earnings surprises were not that crazy, we have very good earnings, which is already a good thing. And also this was a base 2. So this is a base 1, 16-week base, and then we have a base 2 here. Base 1 and base 2 are the most trustworthy bases. So also knowing your stage analysis is important. So yeah, that day, as soon as it closes above, you raise your stop. Now you probably have like what, 1% stop to make 40% maximum. Of course, I think I'd have sold around this day, maybe 5 risks. So that's what I could have gotten. So you can see sometimes if you wait for the 10-day, you're pretty much going to come back as if you just sold at 5 risks. So sometimes it's better to just sell at 5 risks. But you can never know. If it's something like Root, that means you missed out on a 600% move if you sold at 5 risks, because 5 risks would have been here, which is still good money. But of course, you'd feel very, very, very bad about missing this big move. So that's how you do the earnings play. If you like anything that you've seen in this video, subscribe to the channel. And before we dive into the rest of the content, everything I'm talking about in this video is offered for free in the newsletter. So go get our free investing guide from the link in the description. At Profit Punch, we find the top 1% of stocks and tell you exactly when to buy and sell, while taking you from a complete beginner to a skilled investor. Our beginner-friendly guide shares exact patterns that helped our members capture massive wins, like Nvidia, which did 200% in 3 months, SMCI, which did 250% in 2 months, and Appfolio, which did 350% in 2 months. Don't miss out on our next big call. If you opt in for the premium version, we also offer a money-back guarantee if our trade recommendations don't cover your subscription cost. That's how confident we are in these strategies. Thank you, and may the markets be with you.